Stacy began her business a couple years ago, and from the outside, everything looks great. She orders new inventory monthly because her products keep selling out. And as things have scaled up, Stacy's solution has been to hire more and more help each time. It seems like a success story for this new business venture until the end of the month comes and Stacy opens up her bank account to notice almost nothing is left. Money came in during the month, a lot of it actually, but it also left the account. And sadly, this is a common story for most business owners around the world. About 50% of small businesses fail within the first 5 years, even while making money. And it's definitely not Stacy's fault, or that 50% of the businesses are bad ideas. The problem is no one teaches business owners how to manage their finances. And what we were taught about profit was wrong all along. Thankfully, today we're diving into the book Profit First by Mike Michalowicz to find out how we can discover a new approach to business money management, one that aims to increase the success rate of businesses and ultimately reducing the percentage of those that fail. Lucky for you, by the end of this video, you'll have all the implementable action tips because we all know it's not just about reading, but actually putting it to the test. Let's start with the biggest problem. Sales minus expenses does not equal profit. Following this formula that is taught in every single accounting class is the reason why 99% of business owners reach the end of the month without anything to take home, even though the business was good. How is this possible? It's pretty simple. Businesses grow, therefore business owners see that growth and add expenses that begin to grow hand in hand. So even if Stacy is bringing in $600,000 in revenue, that doesn't really matter because between inventory and everyone she's been hiring, her expenses are totaling $599,000, leaving her with $1,000 to take home. Not to mention, she has to pay taxes. So what's the solution? The solution, as the book Profit First explains, is to switch that formula around. What would happen if you took profit out of every sale before spending it on expenses? You'd be profitable. Sounds too easy, right? Here's how it's done. Create 5 separate bank accounts. Don't worry, there's online banks that specialize in Profit First to make this a lot easier than it seems. With a bank like Relay Bank, you can open up a new account in less than 2 minutes by just doing 5 clicks. And all the accounts are free. So you have one account for income, one for profit, one for taxes, and one for operating expenses, and the last for owner's pay. Everything that is coming into the business will flow into the income account. Here, you can choose whether to do this next step weekly or bi-weekly or even monthly. I personally prefer monthly. So every month, you'll take everything that came into the income account, and with one click, you'll do a transfer into the 4 accounts. And how do you know how much to transfer? Author Mike Michalowicz has assessed thousands of small businesses and created a chart based on annual revenue with healthy percentages for each bucket. Businesses making anything less than $250,000 a year distribute 5% to profit, 50% to owner's pay, 15% to tax, 30% to operating expenses. Businesses making $250,000 to $500,000 a year distribute 10% to profit, 35% to owner's pay, 15% to tax, and 40% to operating expenses. If your business is making more than $500,000 a year, I'll leave the chart up so you can screenshot the percentages for each bucket. By doing this quick distribution, which you can even leave automated in Relay Bank, you avoid looking at one bank account and thinking you have that money available, but rather get a clear view of how much you can actually spend for each thing. If there's $2,500 in operating expenses, you know you can't hire or purchase inventory that goes above that amount. These accounts will keep you in check, so even if you have $100 coming in, you'll be making money, paying yourself, knowing how much you can spend on supplies, and also having a cushion to pay taxes when tax season comes around. And yes, ideally, you would have started this on day one of opening your business, but it doesn't mean that it's too late. Even if your business is currently operating at completely different and unhealthy percentages, the goal is to start gradually. You can do this by increasing 1% in owner's pay, profit, and taxes, and decreasing 3% in operating expenses each quarter until reaching your ideal and healthy percentage goals. So you think your business can't operate at those percentages? That's the excuse most businesses on the edge of failing give. But you can operate at those percentages. Your business is different, but it's not the exception. The reason why these percentages end up working for all types of businesses, no matter the industry, is in part tied to Parkinson's law. If your toothpaste is about to run out, yet you keep forgetting to run to the grocery store, you make it work with what you have. You squeeze one side, squeeze the other, and it works. Same thing happens with your operating expense budget. You end up getting resourceful with what is in your account because that's all there is. Moving money from one account to another is not valid this time. And ironically, when following the process correctly, you also begin to get fueled by seeing your profit account continue to rise up. You start pinpointing what's actually working and bringing in a good amount of revenue, so you can put more focus on that part of your business. Before you know it, your business is operating at a healthy standard. You have profit celebration days each quarter, and with a quick 1-minute glance, you know exactly what you can spend on each part of your business. So step 1, create those 5 bank accounts. Step 2, set up a recurring date to do your percentage transfers. Step 3, every quarter pay yourself 50% of what's in the profit account and reinvest the remaining 50% to your business. Step 4, when tax season comes around, whatever is remaining from the account after paying taxes, you can move over to the profit bucket. If it makes it easier for you, profit and tax bank accounts can also be opened at another bank. Or a good idea is to have them hidden to remove any temptation of wanting to transfer that money over to another bucket. Saying you'll wait until the business grows to a certain level to implement this will never happen. So begin today, even if you're making $10 a year. That way you have a healthy, profitable, and sustainable business. If you've already read the book, go ahead and drop your thoughts down below. And if this episode left you hungry to know more, the book link is down below in the description.